Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Thanks for tuning in to this broadcast from Bloomberg Quint. We are in conversation, or I'm going to be in conversation with a very special guest, Sridhar Shivram of Enam. Needs no introduction really, but with us in the studio to talk about the here and now and maybe the next 12 months. Sridhar, good having you.
Thanks for inviting me.
No, pleasure is all mine. What's your? It's an interesting time because we're seeing global markets also being substantially higher from the lows that they clocked in December or January.
Correct.
Are you more sanguine about the prospects, or are you a bit worried?
As far as global markets are concerned, if you see, emerging markets have had a great start. They're already up 11-12%. China is up some 18%. So we've had a great start for emerging markets on the back of a reasonably poor 2018. So let's put that also in context that many of these markets significantly underperformed the developed markets. Having said that, India has significantly underperformed that. So India is having its own set of issues with a lot of uncertainties. Also keep in mind that when emerging markets rally this fast, India is more the defensive market. It's like the levers of the emerging markets. So typically when emerging markets rally so fast, so soon, India tends to underperform. Because it's the most steady market which outperforms over a longer period of time. So I would imagine that this underperformance, it can catch up over say in the medium term, maybe in 6 months or a year once many of these uncertainties are over. So I'm still not, I'm reasonably positive on the markets in general, and I think India is offering a very good opportunity right now.
The question to that would be that would it need India to gain in order to catch up, or would it lead to some bit of underperformance from the markets that have had a reasonable start, as you said? Now, the US as well, and a lot of people equate a dovish Fed 2016 to what's happening right now. But the growth numbers for the US as well, arguably after a stimulus-led 2017 or 2018, will be very, very different from what happens in 2019.
So I think the lower growth for US, Europe, Japan, China is all baked in. So it's not like a surprise. Most people are expecting much lower growth. So it's already there in the prices. So for India to outperform from here, it doesn't need others to significantly underperform. If the global sentiments are benign or positive, and if India's uncertainties which are there, including elections and some of the NBFC related issues, if these are behind us, then it's easily possible that India could rally significantly in the second half of the year. So I would say that it doesn't, as long as we don't get a global crisis, and if things are reasonably stable, I think the base is set for India's outperformance.
But that's not your base case, I presume. A global crisis or even a depressionary scenario in the US?
Not my base case right now.
That's not your base case. Okay. The one small question that I wanted your view on, that if indeed, from the looks of it, US and China will have quote-unquote truce or an agreement of whatever sort, which leads people to be more sanguine on China. Is that net negative for India? Or no, not quite?
No, I don't think so. So if I look at all the interviews that, say, I've seen from Trump or from the Chinese side, one of the points that Trump makes is that there has to be a reciprocal agreement from both countries, which is that if I am allowing import-free or duty-free imports from China, then the same has to be reciprocated. So I think once they settle down, they'll figure out that there is only that much China can do. So there is an opportunity for India, but I'm not very sure if India is prepared for it. I mean, even if you look at, some of the...
No, sorry, I meant the other way around. Sorry, I meant that if indeed foreign investors start liking China a lot more than what they did 6 months ago, because the growth numbers will not falter too much, would money flow into China versus India, or some of the other economies versus India? Is that a risk for India at all?
See, China is a very large weight in MSCI anyway. It's almost 30%. Plus, there are some weightage changes that are expected to happen for MSCI in May and in August. So there is going to be outflow just on the rebalance, and it's expected to be about $1 billion as far as India is concerned over a 2-month period, just the rebalance. So I think the MSCI weightage itself is a big issue. I can't understand how a single country can have 30% plus weight. But that aside, India isn't that big a weight in emerging markets. So if people are not going to decide, it is not India versus China, because China is such a large weight. It is just that India offers good stock-specific opportunities, and its outperformance over a longer period of time is possibly the best in all the emerging markets put together. So once the macro headwinds and some of the uncertainties ebb, I think FIIs would normally come back. So I don't see this as an issue as India versus China.
Okay. Is that period as well something that we'll see post-June? When I speak to a lot of fund houses which have got international collaborations as well, all of those managers tell me that their global counterparts are telling them that, hey, hang on, we are on the sidelines right now. Let the election get over. Let us see in print what's happened, and then we'll come back on India.
So I heard similar stories in 2014 also, that let the elections get over, uncertainty, then we'll see. As the market started to rally, many of them couldn't wait and they jumped into the bandwagon. So I'm not in this whole thing that elections will decide whether markets will rally or not. If earnings come back and you get a favorable election results, the markets will rally. But am I putting all my eggs based on thesis that it needs to be only the election? At least that is not my thesis.
Okay.
That election is possibly an event which will come and go, and markets shrugged off election disappointments or positive surprises based on how the earnings have panned out in a medium term.
The popular view, I'm sure you are aware of that too, the popular view is that maybe avoid looking at or don't really expect too much from the Indian markets until May. You are saying that's not necessarily your base case?
Correct.
Okay, interesting. I'll come to that as well in a bit. But just before we get to squarely on the Indian markets, a couple of points that I want to scratch your mind on. One is what's your currency view, of course, and how big a role will that play in maybe the equity market performance as well?
So I track the RER very closely, and that number is trending around 114 right now. 100 is like the base case. So India is actually slightly overvalued right now. But India is typically traded between 108 and 114 as the range. When it goes to 120 and above, then there you see some sort of depreciation. Otherwise, in this range, it's reasonably okay. So I don't have any specific view that currency should appreciate or depreciate. It looks fair value right now, and it should be stable unless we get some global crisis. So I don't have any specific view. 114 is a reasonable number because it's within the band.
Okay.
So that's my view as far as currency is concerned.
Okay, I have multiple ways to challenge this or concur with this, but let's not go there. The other question that I wanted was, how big an impact could the new RBI dispensation have on the markets? What do you think happens here on, now that the last policy that we saw, a change of stance and a cut and reasonably dovish commentary?
Yeah, so I completely support RBI's view as far as cutting of interest rates is concerned. I track the real interest rates very closely, which is almost at 4.5%. And I go back to one of the reports that Urjit Patel had written in 2014 as a framework for monetary policy, where they had actually highlighted that the anchor for monetary policy for India should be real interest rates. I'm happy that even though they are not completely following the report, but at least with the new governor, at least common sense has prevailed. And we've seen a stance change and also a cut in rates, because 4.5% real interest rate, nobody is going to put any investments in India. It doesn't mean that transmission happens the next day. Transmission has its own, paths to follow. But as long as RBI is doing the right thing, transmission will happen over a period of time. So I think I'm very happy with the new governor. At least we've seen steps in the right direction. And I don't think, the data is so supportive that you don't need to point fingers that this is based on some change that has happened. In fact, I will question the previous governors as to why they didn't, follow the data, because the data was so supportive. So I would only say that I think I'm very happy. I think we could see a few more rate cuts going forward.
Few more. Not front-loaded, but a few more spread throughout the year.
I would say it should be front-loaded. because your data is going to be supportive only for maybe another 6 to 9 months. So you might as well do when your data is supporting you, and then take it forward as it comes, because it's very tough to predict food inflation beyond 6 to 9 months. Okay. So I would say that currently data is very supportive. We have a guide path till December. So whatever has to be done has to be done till then. And then you take forward as you get more data.
Okay. So is just one last question on this whole macro before we get to the micro as well. What is the bigger elephant in the room right now, or the bigger determinant or the bigger near-term risk to your thesis? Would it be heightened activity on the border and the stress thereof? Would it be election result that could be quote-unquote market unfriendly, or would it be something else on the global front which could derail your optimism?
So I have to say that my optimism is not as if I'm very bullish and thumping the table. It looks, given the price action that we have seen in our market, this looks like a very good entry point to build your portfolio. There are risks, as you mentioned, that we have a risk of election, and it's very difficult to predict what will happen there. And we have some geopolitical risk. There could be some global risk also because of how China and US finally evolve as far as the trade war is concerned. But if I assume a normalized probability and assume what sort of probability I give to all these events, it looks like a lot of it is priced in for a normalized event. If we get a black swan event, then we have to reevaluate. Based on high probability assumptions for all these, which is, say, for the war, it doesn't escalate, we get a favorable sort of a government, may not be as comprehensive as it was last time, and there isn't any major US-China issues. I think the base for Indian markets sort of looking very interesting right now.
Okay. You started off this conversation saying that one key thing one lever that needs to come back is earnings. Yeah. Now, the bull argument would be that earnings have probably come back, save for those one-offs. But I ask that even if there are one-offs, be it Tata Motors and some others in Q3 or SBI or something else in the previous quarters, they do impact the earnings picture for the Nifty 50, right? And there is no way to predict that this will be returned to normalcy. Based on your assessment of the companies that you guys track in order to figure out whether the market-wide earnings are growing or no, what's your base case?
So I will actually again take you back to 2014. So in 2014, we were coming off a cyclical base, and we were in the recovery phase, because if you go back to 2013, we were part of Fragile 5. We also had an election then, so a lot of uncertainties. This time around, our macro is much better than what we had in 2013. And the earnings is patchy for some companies, and it is reasonable for some other companies. So it isn't a universe like it was in 2014. So the reason why I'm saying this is that now it is very stock specific, or maybe very small sector specific as far as earnings is concerned. So am I looking at the entire market earnings and determining whether this was going to determine how the market's going to be? It's going to be tough because there are too many moving parts. But if I take particular pockets and I see there is real opportunity for significant earnings growth, and those are the pockets where we are trying to evaluate right now opportunities to invest.
Okay, as somebody told me, you don't have Nifty futures in your portfolio, you have specific companies, so maybe look at that. Having said that though, I mean, markets and the earnings support that the Nifty or the Nifty 100 or whichever universe you take as sentiment barometer of the market, it needs that for that particular index and the sentiment to remain stable for your companies, even if they're delivering earnings in order to do well. Do you think that will happen? Because it's been 4 years or 5 years or maybe even longer.
Yeah, I think that could happen significantly only because of one reason, that financials are almost 40% of the benchmark. And 1920, we are going to see significant earnings improvement, not because of any major reason. Just keep in mind that most of the corporate banks had at least 3.5% of credit cost. Just to put that in perspective, if you had like a 5 lakh, if your loan book was say roughly in the 5 lakh, not specifically giving any company loan book, a 1% credit cost is 5,000 crores. And you were actually providing, say, 15 to 18,000 crores as your credit cost. that credit cost 15 to 18,000 crores, if it shrinks to say 5,000, you're talking of 10, 12,000 delta for each company. So I think that entire financials basket will see a significant earnings revision for the coming year, and that itself could lead to earnings growth for the market, which is currently pegged between 18 and 20%.
The street at the margin has turned bullish and not fully baked in or partly baked in or whatever, but starting to bake in this earnings growth expectations or estimates as well. We saw glimpses of that in quarter 3.
Yeah.
You think the run rate gallops further in quarter 4 and FY19?
I think it will start from the next year, because quarter 4, I'm not very sure if the same run rate, because some of the cleanup may still be required for quarter 4 also, because some newer issues are coming up, ILFS and some other companies. So once those are really done, then I think FY19-20 looks like a good base. But in general, also the other thing is that when you have an election year, generally discretionary consumption goes up. Keep in mind that this is the biggest spending bonanza we get every once in 5 years. And this will have ripple effect in the economy in general. So discretionary spending generally goes up. And so if I put that also into context, we will see earnings bump up even for discretionary companies.
In your assessment, this 2,000 rupees PM Kisan Yojana also aids to that? Because they're not going to buy houses.
So it is not just 2,000 rupee of PM Kisan. So if you look at the GST reduction over the last 12 to 18 months, that number itself is tracking close to 80-90,000 crores. And that doesn't come in one go, right? Because it is the reduction in tax that the government has foregone for the entire year. So that is also playing through, that the entire system was paying 90,000 crores more of tax. That has also come in. Add to that the the loan waivers, which are well in excess of say 1,50,000 crores if you add all the state loans. So these are all various stimuluses that we have seen. So if you put all of this together, I think that the base is building up for fiscal stimulus led consumption growth.
So staples are expensive for a reason.
Yeah, so staples, how much can you consume, right? So the growth for staples will be restricted to 8-10%.
Move from unbranded to branded, move from a slightly lower price point to a slightly higher price point.
Even with all that, the best we are seeing is the 10-12% growth. So I don't see too much of growth for staples.
So what benefits because of this
consumption? So as I said, discretionary really benefits. You could see durables. So those are the areas where if you get more money you spend, you won't really go and buy one more toothpaste because you got 2,000 rupees. So you may end up buying possibly a mobile phone or something else. It need not always directly have an impact on the market, but it has a second derivative impact, because of the spending, then there's more spending because somebody else is selling more, and things like that. So as long as the velocity of money is good, it helps the economy in general, and that helps the earnings for the markets.
Okay. Something that perceptibly put some brakes on that was this whole NBFC issue.
Yes.
Now, if I speak to Rajiv Jain, he says that we are open, our books are normal, and the numbers show that their lending hasn't stopped.
Yeah.
Maybe HDB Financial's lending hasn't stopped.
Right.
For some of the others, that's not been the case.
Correct.
So, single question, but two answers that I seek from you. One, what impact would that supposed cramping down of lending from NBFCs into all walks have on the consumption space, if at all it's had, and if it's improving? And two, on that space itself, NBFCs, now that it's been a couple of quarters or more than a couple of quarters since we've seen the ILFS issue happen, what do you envisage the next 2 or 3 quarters to be like?
Yeah, so first, the impact of the NBFC crisis itself. So if I go back to say sometime in August, generally the companies were very bullish on the demand scenario. It looked as if we are heading to very good earnings season, especially heading into the festive season. And then we had the speed break of NBFC and the entire crisis that came about. I think that has had a significant second derivative impact on consumption. Whether we like it or not, many of them were funding second-hand trucks, scooters, consumption for durables, many of the other things. Yes. It came to a standstill. It has also resulted in larger issues like builders not getting funding. As a result, the construction has stopped, so the construction worker not getting his wages. and the entire second derivative impact of that. So I think the fact that we've had a significant slowdown in the third quarter is also related to the impact that the entire NBFC crisis has had. I think a lot of it that is abating now, and things are normalizing. I would just hope that RBI and the government take very stern steps as far as this is concerned to ensure that it doesn't spill over into the mainstream economy. And as far as the NBFC HFC is concerned, I've been very negative on HFCs in particular, and I've maintained this for almost 2 years now, and I still maintain the same. And my negativeness comes from the fact that if I look at a typical HFC, the book, it only about 60-65% is mortgage. The rest is all builder and lab book. And we all know that builders are having a lot of issues. A lot of banks are actually declaring them as NPA. But HFC seems to suggest that they have no NPAs at all. Everything is perfect. And 1 or 2 stray incidents, but they have no issues, which can't be, right? So the crux of the problem is that HFCs are governed by NHB, which is the regulator. And in my view, they are a very weak regulator. And the regulations are not very strict. So for an HFC, you could restructure a builder loan, and you need not disclose it to the minority shareholders. And I have been highlighting this to the regulator that they should actually change this so that the regulations are similar to banks. Banks, you can't restructure even today after the Feb 12th guidelines. My point to them that, yeah, if they want to restructure, it's fine, but at least they should disclose it to minority shareholders. That hasn't happened, which is why we are seeing all sorts of rumors and crises floating around for HFCs in general. I think NBFCs come under Reserve Bank, so they are better governed than HFCs. So in my view, if RBI and the government come together and at least streamline some of these, that will go a long way in reducing the anxiety of a lot of people who are either lending to NBFCs, HFCs, or the deposit holders of some of these HFCs.
If that were not to happen, you fear we are just kicking a can down the road, some accident waiting to happen?
I think so, especially HFCs, because the builder exposure is too large and they are really not recognizing the problem. As a result, we keep hearing rumors, which doesn't help their cause. It's not as if their market caps are safe. Their market caps have corrected 60-80%. So it's better to disclose it and take the difficult steps now and move forward.
Interesting. Speaking of builders, since you brought that up, this budget and the GST Council meet 3 days ago seem to suggest that there is, whether for the right or the wrong reason, separate thing, but there is cognizance of the fact that this sector is under distress and needed some assistance.
Correct.
Some of it has come back. For the last 10 years or last 5 years at least, I've heard these stories of how the stronger builders will grow disproportionately because the sector which contributes 9% to the GDP can't have only 1% of the market cap. How are you viewing this space? So, is it investable?
No, for me it's not investable. But I was seeing some interesting statistics from some consultant who was showing that over the last 7 years, the builders, say 6-7 years back, 70% of the funding used to come from banks. Now it's the other way around. 70% of the funding is coming from NBFC, HFCs, and 30% is coming from banks. So I would want to believe that banks are more prudent in assessing their risks, whereas NBFC, HFCs are more risk takers. As a result, what we have seen is because of the excess liquidity that was there in the system, many of the NBFCs and HFCs have gone and lent indiscriminately. I would actually also put the mutual fund industry in this. I don't think they have behaved in the best manner. Especially, I'm sure many of the paper that they have bought, the equity fund managers wouldn't have touched. But the debt fund manager continues to support them. So I still don't think all these SOPs that the government has given is enough, because what we need is the animal instinct for the home buyer to come back. And that hasn't yet come back because property prices, one, I think they still haven't corrected enough, because it's an asset class. Yeah. If you look at any other asset class, even if you look at the retail rental market or the office rental market, they've all corrected. The residential market seems to be flat. It just doesn't correct.
Unless you go with a checkbook and ready to sign the check.
Yeah, which we don't know, right? So it's a very opaque market. So once the builders realize that it's better to, sell your inventory at a price where it is selling rather than holding it for 5 years and doubling your cost. So you're better off clearing your inventory. I think once this sort of model comes and we see that real estate players actually, start a project and complete it within 3 years, sell it and move to the next project, the whole concept of minority shareholder coming in there and playing doesn't really play out well.
Not even for the 3 or 4 large ones. I mean, large in relative basis. Without getting into names, but I'm just, in order to exemplify my point, the Godrej Properties, Oberoi Real Estates, in a bad sector, good companies growing large might become larger. Not a good
I'd rather look at a REIT. So once REITs get listed in India, I know that assured cash flows from commercial properties there, plus I know that these properties will appreciate. So I get a good yield plus an appreciation.
Okay.
I rather play real estate through a REIT than actually investing directly into any of these companies. This is my personal view, so I'm sure different people will have different
views. Okay. A couple of other allied spaces. Since we spoke some time ago, I want to bring up insurance again.
Yes.
Your call turned out to be fabulous in the sense that you were saying that you don't want to get into these names when they were the fancy of the market.
Correct.
All of them have corrected, trading near 52-week lows. A bad sector is also good at a good price.
Yeah.
Are these stocks at a good price right now or a good valuation right now?
So the point which I made then that they are actually cyclical in nature, life insurance, because we are not selling protection. We are selling investment product. To start with, I'm unhappy that they are actually selling investment products. And number two, their 61-month persistency ratio is still at 50%. For a cyclical business whose persistency is 50%, these valuations still don't add up for me.
Okay.
So if you actually ask me, I'm still better off with the general insurance business. So the general insurance looks much better because just a broad math for general insurance is that their investments are roughly about 3.5-4 times of their net worth. So if I calculate, if I have an investment book and I calculate say 7-8% as the return in the investment book, adjusted for tax, it's say 6-6.5%. So I get about 24% ROE just from my investments. Then if I have a combined ratio which is less than 100, then it adds to my ROEs more. So I'm talking of a business which can steady state give me a 30% ROE. This is much better, if you ask me, than a life insurance. I am still bearish on life insurance, not for the cyclicality of the business. The valuations are too expensive. I can get a similar business with similar growth in China for possibly half the valuation.
Okay, interesting. Last couple of questions. The other high frequency indicating sector of sorts, autos, a bit of a reset. Stocks have come off. They're staying low, clearly indicating that the investor appetite is not as strong as it was in 2018. What leads to the investor appetite coming back, if it does? Would it be the NBFC's thing or something else?
I actually like this sector, especially the two-wheelers.
Interesting.
And it's part of the discretionary basket. And I think given where the valuations are, so at some point they were being valued as a consumer company. So the valuations were too high for a consumer discretionary company. Typically it gets valued at a much lower level. So today I think the valuations are reasonable, but growth has also come off. My view is that this is cyclically low right now because of various factors. One, they've had some regulatory changes that we have seen. We may see some more because there's some changes which are coming up. And also we've had some funding related issues which have come, plus competitive intensity has generally gone up. My view is a lot of this is a good point to look at some of these stocks and enter them. It's not as if your outlook for the next 6 months is great, but this is a good time to build a position in some of these two-wheelers. Maybe with a 18-month view, they may possibly give good returns.
Interesting. My final question would be on the internationally impacted spaces, if I can use that term. I mean, with the pharma, IT is one pocket, two metals as well. I remember our conversations in the past, you had some very strong views there.
Right.
What are your thoughts now?
So metals, I'm really not an expert on metals.
But you had strong views in the past,
yes, but our house has a very strong view and we've done fairly well getting in and out. And we have significantly reduced our position in metals. But given that we take really 3-5 year view, So we may sit at the bottom of the cycle for 2 years and stock may do nothing. Not something which many other fund managers with benchmark issues can do. Currently they have their own set of issues, but as valuations come down, some of them do look interesting. IT, I'm not a big fan because the growth rates are really in the single digits. You talk about 8-9% growth rates. NASSCOM has declined to give their guidance this year. So I was reading an interesting statistics that if you look at the top 20 IT companies in the world, out of that 11 are from the US and 9 are from China. And the same number 10 years back, you had at least 2 companies from India. So what has happened is that China has actually really gone ahead and taken significant strides as far as IT is concerned. We've been left doing the mundane job, which is more, in my view, body shopping to some extent. We talk of digital, but I don't think these are really cutting edge digital. We haven't created any IP to really talk about. So I think India's really missed the IT bus, and if we don't change, then we may become insignificant, given that you have AI and machine learning and many of the others technological developments that are coming today that could actually impact the low-end job that India does. So I'm not a big bull if I look at IT from a 3 to 5 year. Given that currently people are finding hiding spaces, this is a good hiding space to be in. But will you make big money out of this? I doubt. I could be wrong, but that's my view. On pharma is very stock specific. Okay. I think again we've seen very high valuation for this sector, and now that has come off significantly in line with global valuation. So Indian pharma always used to trade almost 2 times that of global generic pharma like Teva or something or the other. That has really come down significantly today, and I think that's a good sign because people have figured out that both of them have similar risks. Very stock specific. I'm not a big bull on pharma even now. Okay.
Well, but bullish on the markets is Sridhar Sivaram, and I think that's a good note to end this interaction with. Thanks so much for taking the time out, Sridhar. Pleasure having you.
Nice. Thank you very much.
And viewers, thanks for tuning in to this leg of Navigating Through Uncertainty.